In this video, we're going to go through a market sizing case which you could experience in a consulting interview at places like McKinsey, BCG and Bain. And before I got an offer at BCG, these were the cases that I put a lot of practice towards, and I would recommend the same to you, and watching this video is a great start. But if you want more tips and practice cases, then definitely check out our complete case interview course on our website that's linked in the description, which will contain all of that and more. But for now, let's get right into the case and start by explaining the case brief. After successfully servicing large beverage companies over the last 20 years, our client, the CEO of High Quality Bottles or HQB, a small plastics manufacturer and bottling company, wants to expand into the hospitality and leisure space. Specifically, she wants HQB to supply local hotel chains with bottled toiletries like shampoos, conditioners, and shower gel. HQB already has the interest of local hotels in their hometown, and they need your help in identifying the potential size of this business and deciding if it's worth pursuing. How would you approach finding the attractiveness of this opportunity for the first year in this expansion? Now, before I go on to solving this question, it's always a really good idea to make sure we're clear on what we need to do, so we need to ask clarifying questions. Now, there are two questions that I really want to ask here. Firstly, are we measuring this opportunity by revenue or by volume of sales? And let's say for this case, we're focusing on how much money they would gain from this opportunity, so that's revenue. And secondly, I think it's really important that we ask them to tell us more about the hometown, because that would change the answer dramatically. For example, is this hometown a massive city that lots of tourists visit every year, for example? To which they respond by saying, on average, at any point, the hometown has around 1,000 tourists. So now that we're clear on the situation, we can start to try and solve this problem. So let me explain the general approach I'm going to take with this question. Firstly, I'm going to tackle the problem of working out how many hotels there are in the hometown, because to work out how much money they're going to make, we need to know how many potential buyers there are. Then, we're going to work out how many stays in a year are there per hotel, because even if there are loads and loads of hotels, we're only going to be making money if there are actually people going to these hotels. And a really important point to keep in mind here is the occupancy rate, and we will get to that a little later on. And the final step is to work out how much money HQB are going to make per stay, so revenue per stay. Now, if you don't currently understand how I'm going to be putting all these component parts together to get the answer, just hang in there, we'll get to that towards the end. So let's firstly try and work out how many hotels there are in the hometown, and we're going to use the fact that they have 1,000 tourists there at any time, and by assuming only tourists go to these hotels, we can use a supply equals demand equation. So the supply side looks a bit like this, and this will calculate the number of total rooms there are in the hometown by multiplying the number of hotels and the number of rooms per hotel. Then on the demand side, this is simply going to be the number of tourists, and that's from our assumption. And because we want to know how many hotels there are, we can rearrange this equation to get this. So let's actually calculate this. Assuming each hotel has 50 rooms, we would get the number of hotels to be 20. However, we need to remember that hotels are very rarely completely full, i.e. they don't have an occupancy rate of 100%. So let's just increase this a little to 25, as 25 is still an easy number to deal with, but also makes sense in this scenario. So now, from our general approach, we can cross off the number of hotels and focus on the next stage, which was the number of stays per hotel. And to break this down, we're going to use what is called a calculation tree and put number of stays per hotel, and that's in a year, as the top box. Now firstly, it's quite hard to think in good detail when the timescale is so large. So let's break this down into the number of stays per hotel in a week and the number of weeks in a year. And because in market sizing cases we don't need to be incredibly precise, for ease of calculation, we're going to say the number of weeks in a year is about 50. Now we need to remember that not every room is going to be full. So let's break down the left hand side into number of stays in a week per occupied room and then the number of occupied rooms. And if we say that on average people spend 2 nights at a hotel, that's probably quite low, but if we say that people normally go for a weekend, then that could be roughly correct. Then this would mean that the number of stays per occupied room in a week is about 3. Then to work out the number of occupied rooms in a hotel, we need to multiply the number of total rooms, which we've already assumed to be 50, by an occupancy rate. And let's say this rate is around 80%, as this seems fairly reasonable, but also makes the calculations quite easy. So now that we have estimations for all the bottom branches of our tree, we can get on to the calculations. So firstly, the number of occupied rooms is going to be 40, and then from this the number of stays per week per hotel is going to be 120, and finally we get the number of stays per hotel in a year to be 6,000. So what we're doing here is working our way back up the calculation tree to get to the top box, which is what we want to get. And now, looking at our general approach, we can cross off the next two to just leave us with the revenue per stay. So let's work this out using another calculation tree, but a much more simple one. So let's break this down into the number of bottles per stay and the price per bottle, i.e. how much money HQB make from selling one bottle of the conditioner, shampoo and shower gel to a hotel. Now, I said earlier that on average people spend 2 nights at a hotel, so the lotions probably won't need to be replenished during the stay, but let's say people often use a bit of each 3 lotions, so we can estimate that the number of bottles per stay is 3. And let's say that it will cost the hotel 50 cents to buy one bottle because it probably won't be that expensive. And therefore, we can say that the revenue per stay for HQB is around $1.50. And with this, that means that every component of our general approach has been estimated and we can actually get on to calculating the market size. Now, by saying market size is what we're going to calculate, we're making a big assumption, which is that HQB receive 100% market share. Now, that's likely not going to be the case, but by calculating a market size, you're going to get a reasonable estimate. So, to do this, we firstly take the number of hotels, and then multiply this by the number of stays per hotel in a year. And finally, to get the revenue HQB could make, we need to multiply this by the revenue per stay. And from all our previous analysis, we have estimations for each of these components, and by doing the maths, we get $225,000. But the case doesn't stop here. If a case is purely a market sizing case, then they would likely ask you another extra question, which, for this case, is what other information should the client know to determine whether this is an attractive business to enter into. Now, to answer this question, I think it's really good to split your ideas into the internal factors and the external factors. So let's start with the internal. And the first thing I want to talk about is costs. So that's things like fixed, variable and investment costs. And this could contain things like the cost to actually make the bottle, buy the lotions that go inside the bottle, etc. Secondly, the true revenue per bottle. We estimated this to be 50 cents, but knowing exactly how much you could sell it for will really help your analysis to determine how good of an opportunity this is. Thirdly, supply sourcing. How are you going to get the lotions? What suppliers could you use? And like I said before, how much will this cost? Factory capacity. Does the current factory have the capacity to add this to the product line, or will they need to expand? And finally, logistical issues. How are you going to transport these bottles to the hotels, for example? And there are lots of other logistical issues here. And then, in terms of external factors, you could say things like the true potential market share, so the competition. We assume this to be 100%, but that is definitely not going to be true. So we need to look at our competition and how we can persuade hotels to sign contracts with us rather than them. Also, sustainability trends. Plastic is definitely not a good building material in terms of sustainability, so do hotels actually want the lotions in more sustainable packages? Thirdly, the growth of the local tourism industry. Is this industry looking like it will increase or decline going into the future? And finally, we should factor in business travellers. We only included tourists in our analysis, So is there a big business community that travels into the town, and could this mean that the market size and the opportunity is bigger than we thought? And with the extra question, that marks the end of the case. Now, before you go, I would really recommend checking out our website, theconsultingaxis.com, because if you really want to get into consulting, our Become a Consultant course will dramatically increase your chances. But for now, I hope you enjoyed this video, and I wish you all the very best of luck with your consulting applications.